Welcome to the Dividend Talk podcast, episode number 2, an introduction to ETFs. Hey guys, welcome back to another episode of Dividend Talk. I'm your co-host, Engineer My Freedom, and today I'm with my fellow dividend growth investor, European DGI. This is a podcast where we discuss our passion and knowledge for investing in personal finance. We will take a brief look at the news and we'll also share our stock pick of the week, so stick around for that. All of this with our very own unique European flavour. We are delighted that you could join us today, and if you're new, please like and subscribe to us and check out our previous episodes on YouTube and Spotify. As always, comments and feedback are always welcome. See you on the inside. Hey European DJI, good to see you again. How's your week been?
My week is really great. It was really busy at work. But before we start actually with this podcast, I would like to say congratulations to you. I took a whiskey sour with me. I think Irish whiskey, because I think one of your favorites football teams became champion.
Oh, I'm so happy. 30 years we've been waiting for this. Incredible. What Jurgen Klopp has done, came in and changed us around. It's fantastic. I'm so happy you wouldn't believe.
So tell me, what was the feeling you had when you heard that Chelsea won from Manchester City? Were you watching live?
I wasn't. I couldn't watch live. I was texting my friends. I said I can't watch. I just wanted to wait. So I turned on Sky Sports at 10:15, and then just to see Liverpool are champions, get little butterflies in my stomach. But it's been a long time coming, and to watch my son, he's 8, he's a massive Liverpool fan, and he celebrated like he won the league, and it was incredible. I just wish that we could actually go to Liverpool and celebrate with the fans, but it's amazing.
Well, what can I say? I've been watching several of their games this season before all this happened with COVID-19. And what I can tell you, cheers, mate. Well deserved. And I know there's a bit of a Dutch flavor in it with Van Dijk and Wijnaldum. And well deserved. And it was really great to watch Liverpool this season and last season. They should have won it then already. So enjoy it.
I will. Thank you. Thanks very much. So getting back to our business, really. Have you been looking at the news or anything stand out for you this week?
Yes, for me, there was great news around Bayer. Bayer is a pharmaceutical. Well, actually, it's a life science company, so it has a few branches. It is a pharmacy branch, but they also are really big in how do you say it, food science, I guess. So they purchased Monsanto 3 years ago, I guess. I was not always such a big fan of this acquisition because of the reputation of Monsanto. I watched a Netflix documentary at the time as well, and seemed to be a really aggressive company, playing more their business in court than anywhere else. So Bayer, as a German company, purchased it. A total misfit in culture, in my opinion. But what they got with it was also a really, really big issue with the product Roundup. So Roundup in America is being challenged a lot for effectively having an impact on cancer for people that are using it a lot. So there are many settlements, and this week they finally agreed, after I think more than a year, to settle for 10 billion, I think dollars or euros. They're almost equal, but for me this is like an unbelievable story about how you can make such a poor decision in an acquisition, a total misfit in culture. I understand it from a portfolio point of view. And actually, if you run the numbers, the portfolio is doing quite well. But, to pay now 10 billion in settlements, and I found the board of directors so poor also in dealing with the case. You can clearly see that Bayer was not used to this, to the American culture of claiming and going to court for these kinds of things. They were really struggling with it. I'm just glad that they now, how is it, settled. It's 10 billion, 10 billion money. It's a lot. And I hope that that the board of directors and such give all their money back for this merger and for this acquisition. Also, the company that helped them with the deal. I mean, this was one of the poorest deals that I've seen in the last 5-6 years, and specifically from a European company. So I hope they can leave it behind them, because if you look at the data itself, the stock is still actually pretty good. Dividend was flat last year. It has a pretty good yield. I see it going over time back to 100 euros. So I'm actually quite happy with it. I own 100 shares of it. So I didn't sold them just because of the fact that I thought that they were, at the same time when looking at the data, that they were also undervalued. And I knew that it was because of this roundup case. So that was for me the big news. I hope that as an investor and a shareholder, that we can leave it a bit behind now. But if they, sorry for my words, but if they screw up again, the board of directors I will straight away hit the sell button.
Yeah.
So that was my big news. Yeah. How about yourself? Any specifics in the news last week that triggered your curiosity or your mind?
There was two pieces that jumped out at me this week, and the first one is that AT&T have decided to pay back some of their loans early. For me, it's important for me because they make up quite a large portion of my portfolio. I think 9 or 10%. So it's quite a big deal, really. I was worried about their level of debt. I think they have a huge amount of debt, but they are growing very fast. I think with fiber, 5G, HBO Max, I think the future looks bright with them. So for me to see them managing their debt was really important, and to see that they're paying back. I think it's 4.3 billion prepayment in, I think, bonds, and another 1 billion in prepayment of a term loan. So it's quite big news, and welcomed in my portfolio. And the second piece of news, which triggered me, was that I saw KLM were being bailed out by the Dutch government today. I was quite curious as to your thoughts on how you felt about that.
KLM, yeah, this is an interesting story, because this is often in Dutch news because they merged with Air France, and there's this feeling in the Netherlands that KLM is not growing really, or getting what it deserves because of Air France, the parent company, while KLM was firing on all cylinders. So there's a lot of sentiment around KLM. Personally, I'm not attached to it at all. I love them as a company to use, to fly with. Good service, also good social media. If there is something, they usually help really quickly. But I'm totally not interested in airline stocks. Bailing out KLM, yeah, I'm not surprised that this happens. Same with Lufthansa, was the same, right? I
Yeah.
think as a dividend growth investor, airlines make just a really, really poor investment case. And so I'm usually stay away from it, and I have no sentiment at all towards KLM. Yeah.
Yeah, it's interesting to see airlines being bailed out. I'm not quite sure how I feel about that. I don't know if airlines should be bailed out. I know Ryanair voiced their opinion that it's adding an unfair advantage to the sector, but I don't know how I feel about it. I could understand banks maybe, but airlines is.
Yeah, I get your point. I think there's a lot of national pride somehow around airlines. There's a whole ecosystem around it as well. So if you look at Amsterdam airport, if KLM would not be there anymore as a carrier, I think it would not be just KLM and the employees there. I think there would be a really big shock to the local economy in Amsterdam. So I do understand why governments are tempting with a bailout in here, because it could just ruin a whole economy, a whole local economy. So I do understand that. So in general, when governments bail out, I don't really have an issue with it, as long as if there was, for instance, fraud or something like that, that they lock up the CEOs. Unfortunately, the law is not really that easy to do that. Secondly, I would like them to take an ownership so that any price appreciation in the stock goes back to the taxpayer. And thirdly, I would like to see clawback rules to the board of directors and such that effectively made the mistakes in the past for why they need to be bailed out now. And I think this is really, really what you see with Delta Airlines and American Airlines, where they were really buying back a lot of stock, and now suddenly they need to keep their hand up and ask for money at the government. So I have no particular issue with bailing out as long as the taxpayer benefits from it in several years again. Hey, but EMF, having said that, let's start with our main topic today. So today we decided to talk about ETFs, trackers, and I think this is a really interesting story. I remember you just wrote something about it as well. Today I also wrote a little bit about it. And I don't know how it is for you, but I often get the question like, hey DJI, you're building this whole portfolio, but it's effectively an ETF. So why don't you just build ETFs? I guess you're getting often the same question, and it will probably also trigger your mind a lot.
Yeah, of course. I get this question quite a lot.
Yeah.
And when I started my journey, I think I've mentioned this before, but ETFs is one of the investment vehicles that I was looking at initially. It seems so easy. You just pick a fund and you're invested in lots and lots of different stocks and indices at the same time. So for most people, it makes sense. But as you know, as European investors, it's got a little bit harder over the last few years. I think it was back in 2017, there was a regulation brought in by the EU under, I think it's PRIIPs, PRIIPs, Packet, Retail and Insurance-Based Investment Products. And this regulation meant that all providers of these funds had to provide a key investment information document, which is no big deal, right? However, you see some of the big providers like BlackRock and Vanguard just won't provide these for us anymore. So that kind of makes it a little bit harder for us over here to invest in some of these funds. So we do have some options, and you wrote a great blog post today about some of the dividend aristocrats, for example, and some of them that you can invest in under, I think, UCITSs, where it's an equivalent of a Vanguard fund for all the world. But there is some difficulty in finding exact funds. I think there was one fund in particular for you. Was it the appreciation fund or something that you couldn't find on the Guy Run? And I find this quite a lot. So when you're reading books, and I read The Simple Path to Wealth by J.J. Collins. I don't know if you read it, and it's a great book, and it really outlines a simple path to wealth using ETFs. And it's something I'd probably advocate only for. It's just so hard and so difficult to invest in these type of funds for us, especially for me in Ireland. I'm not sure about other parts of Europe, but in Ireland it's certainly more difficult to invest in these vehicles. We also have huge tax laws over here. So I wrote a post on Twitter today. I actually bought an ETF, an accumulating ETF for European shares there recently. And it's just really, for me, it was just to get some exposure to European markets because I'm heavily invested in the US. But I mentioned on Twitter that I will have to pay 41% tax on any gains in the next 8 years, even if I don't sell. Yeah. So that's called deemed disposal over here. So even if I don't sell, I will have to calculate my gains and pay a tax of 41% on that. So it's
And if you would sell before, let's say after 2 years, does the same rule apply?
Same rule applies. So if I sell beforehand, it's still the same. It's still 41%. Or if I hold, it's 41%.
Wow.
So for me, it makes more sense to invest in accumulating funds. So there's two different types. There's distributing, which will pay you dividends quarterly or yearly or semi-annually, and then you've got accumulating funds that reinvest it back into the fund. So for me, it makes more sense to have an accumulating fund because I'll only pay that tax after 8 years and then every year after that. Whereas if I was to get a distributing fund, I would pay 41% upfront every single year on the dividends received. and that's before I reinvested in. So I'm only reinvesting in after tax funds then after that. So it's quite a big difference. I think it works out about 6 or 7% in the difference over a long period of time.
Wow. So what I do know, I did in the past quite some research on iShares from BlackRock as well.
Yeah.
And I'm living in Poland, so I checked there. It's really hard. Then I checked in the Netherlands as well. Then I checked in the UK, and what I'm observing is that even within Europe, the availability of certain ETFs highly differs. I see that the UK is a little bit more similar to the US. You have a little bit easier access to US ETFs, but in other countries it's really hard. So of course I didn't check all the 27 countries in Europe, but just the fact that in 3-4 countries I see already so many differences makes it really hard. And I'm really wondering from a company like BlackRock as well, like what makes it so hard to the European investor to make the typical Vanguard US funds available? What is it? I don't understand it. Maybe one of the readers or listeners will understand it. But for me,
It's
it makes
just
no
this
sense.
document, isn't it? It's just this document, this key investor information document that I think the EU, it makes sense in a way. The EU wanted this document to protect the average investor from investing in vehicles that they don't understand and losing a ton of money. So it makes sense on that front. But I feel we are being penalised by Vanguard and by BlackRock by them not supplying. It's a 2-page document. By not supplying this document, it is possible to invest in these funds. I know this if you go through an institution. So we've got a website in Ireland called moneycube.ie, for example, and they're an institutional investor and they can invest in these funds for you. But obviously there's minimum thresholds and the fees are higher, and it might negate some of the advantages of investing in these funds. But for me, I find it quite frustrating that we can't just invest at a level playing field with our US counterparts,
Yeah.
or even the UK counterparts, so to speak.
Yeah. And do you also see some advantages in general in using ETFs besides the tax part, let's say, and the accessibility to ETFs?
There is advantages, and one of them, the main one, is diversification. So you have easy access to diversify your portfolio in a low cost fund, so to speak. So you've got a TER of typically 0.22%, and it's low cost, and you can get a wide range of stocks. So that's one of the reasons why I chose the European stocks ETF, because I have no exposure really to it, and I wanted to start building up some exposure, and it cost me a lot more money to get that level of exposure buying single stocks. So it's kind of like a placeholder for me. I will get the ETF, but I will start building up individual stocks over time because it makes more sense for me tax wise to do that.
Yeah. So what I can tell you is that after, and I'll put the links to our posts also in the description around below the YouTube video. What I can say is that actually the only one that I'm interested is the VIG ticker from Vanguard, Dividend Growth. That will be the only one that I'm interested in because they have a really strong track record. It goes in lockstep with the S&P 500 in general. The only thing is I find it relatively low dividend yield, and that's probably because the general market is overvalued. But if, for instance, this ETF would drop to something like 2.8% dividend yield, 3%, I will probably buy some. I can see some fit for it in my portfolio. So that's the new thing that I learned, because it had also around 7% growth over a decade in general. Because one of the things that is important for me is that if I'm in retirement, that I don't suddenly lose 10 or 20% of my income. So I will build in a margin of safety before I would financially retire. So yes, it's okay when I would have a bad year because of a recession and I would lose 5% of income. And in that case, the Vanguard index would have a fit in my portfolio. So that's one of the things I would consider. But if you look at the index itself and the top 3 stocks, there are a lot of tech stocks in there as well with low yield. So I understand why it's currently having a relatively low yield. But yeah, I would consider that one. But that's probably the only one that I would consider, and only via one broker that I have. where I found it by coincidence. So it's for me, that's really hard. And I also saw the other day on the Hero, for instance, and I saw it on Twitter, that the Hero also started stopping some access to certain funds. And I saw some complaints about it, that suddenly some people got a message saying like, hey, in December, we will not supply these funds anymore for you. So we will sell them automatically if you don't take action yourself. So besides even the accessibility, even when you're investing in low-cost providers, there's always this risk that they will pull those those offers away that they have, and there you are. It's really annoying as a European investor, because you cannot trust on it that 5 years from now you can still dollar cost average in such an ETF.
Exactly, and you can't plan for that either. You never know when the carpet is going to be pulled from underneath you and it's going to be taken away. And if you are dollar cost averaging, you could be unlucky and you could be buying at the top and all the way down, but you might just miss it then on the way back up and lose all your gains. So it is a little bit riskier, I think, for us over in Europe, and we have to be a little bit more careful in which ETFs we invest in. But one of the things that surprised me actually is I read your blog just before I came on was the performance on some of the funds. They were way below what I expected, and considering Morningstar gave one of them a 4-star rating and there's no growth at all, it's quite astonishing, and really pushes the point of research and make sure you understand what your fund, what your ETF is involved in, what companies they're in, the sectors they're in, and how they're growing before you get involved in them. And it's probably more important as a European investor, because picking that right fund could be the difference in making money or losing money down the line.
Exactly. If you're a European investor and you would just throw money in a European dividend fund and you do that for 20 years, you might just miss out on 200, 300,000 euro just by the fact of choosing the wrong indexes. So yeah, I'm fully with you. When I saw that, like 10 years, nothing happened. That's why I use the term duck there, because everything looked bad. And then Morningstar giving it a 4-star rating. And I know that Morningstar looks also with the ratings on whether it's undervalued or not. But there's not even just value in it. So you, in my opinion, I couldn't even say undervalued or overvalued. It was just like blah.
Yeah.
So I find it a shame that Morningstar even gives it a rating. It should have just put it on a blacklist and just plainly say, individual investors, please don't pour your money in here. It's going nowhere. Poor diversification. Everything is bad about this about this ETF. Stay away. That if they would be really honest to the investor, that should have been their recommendation. So yes, I'm with you. It is astonishing, and it just tells us that we need to do our own homework. And for me, it's also just a clear case that as a European investor, I think if you really want to become financial freedom via dividend growth investing, you just need to build your own portfolio. You've got way more power in your own hands. Yes, I do know that it comes with time investment, but the alternative is just poor performance, in my opinion.
But yeah, I would 100% agree. Poor performance, and you might not reach the goal you set out to achieve. At least if you choose your own stocks and put in that bit of time up front, you have the ability to see how it's growing and adapt and change as time goes on. But I would be interested to hear from our community and our listeners, particularly from Europe, how they handle ETFs and where they buy or what they buy, and if they have an ETF portfolio. It's the one subject I'm really interested in, and any comments or any feedback and advice on it would be really appreciated.
Yeah, definitely. I'm also really looking forward for it, because let's face it, we are amateur investors. I totally don't consider myself an expert, but from what I'm seeing, I'm not getting any, let's say, joy out of it. But I would love to be challenged, because for me, it would also make my life easier if I could just pour my money in a certain index and spend my time on other kinds of analysis.
Spend your time on podcasts.
Exactly. Way more fun at times. Okay,
So
so EMF. I think this concludes the topic for us a little bit about ETFs. We might get back to this at a certain moment in time when we maybe hear from our listeners that they change our minds, and then we can definitely also invite one of those to the podcast to explain more. So let's go to our next section. And in this case, I would like to address a few questions that we got from our followers and our listeners. And the first one is from Just Dividends. He asked us the following: what are your favorite European stocks that are traded through ADRs or on the New York Stock Exchange or the Nasdaq? Have you got any thoughts about that one?
good question by Just Dividends, and he's also got a great blog. Actually, if you have some time to read it, it's one that I follow closely, and it's always great content on it. But regarding his question, I currently have two in my portfolio. So I have British Tobacco, and I also have Royal Dutch Shell. So out of the two, BTI would be quite risky. I suppose tobacco is a declining industry, so they are kind of relying on this new vapes and different kind of income streams at the moment, and nobody really knows how that's going to turn out. And then I also have Royal Dutch Shell. So I suppose the advantage of investing through ADRs, and why did I not buy them in, say, a European market like Amsterdam or London or Dublin, for example, is that you pay zero tax on these investments. So when I typically, if I was to invest that through a different exchange, I could probably be paying 15% tax before it reaches my account. Whereas when I invest through the ADR, I don't pay any tax on it at all. What's your take on it? Who have you looked at, or do you invest in any ADRs?
So I will give a few names soon, but if I understand correctly, well, right, this no tax applies to UK based stocks, right, for Americans.
Yeah, exactly. Yeah, UK based.
Yeah, so that would be also my recommendation to Just Dividends. Focus on the UK, and there are some great companies. So I would also recommend Shell. I don't see Shell cutting their dividend again. I think they lowered it so much that they created safety nets so that they can slowly increase again. And I think still the yield is quite okay. I believe in the long-term prospects of the company, and then the energy transition. I think they did a really good transition into gas. It's just too much turbulence on the market, and hence why they got in trouble. But the second one, yeah, Unilever. It's one of my favorite companies in general, and I think it's ticker symbol UL. So Just Dividends, I would definitely recommend you to look into Unilever, and then there's a third one, and I think you know more a little bit more about it. It's like, the one that gives the great whiskey, Diageo. So maybe you can tell a little bit more about that one.
They also hold Guinness, they own Guinness as well, which is our Irish drink. So it's something I pay particularly attention to. But no, they're a great company. I've been watching them for quite a while. I was concerned recently. I was doing some research on this, and their revenue and earnings seem to have flatlined or even declining at the moment. And I suppose this pandemic is not going to help either. There's lots of pubs and shops and everything closed. So they were already declining before this. So I'd be quite interested to see how they're going to navigate through this. I suppose they are a premium brand. They have lots of different brands, and it is a household name. And I've no doubt that they will come out of it and they will get stronger. But over the short term, it's just a bit of headwinds there. So it'll be something that I would consider wisely before investing my money in them.
So usually when I see such things happening, I would like to see an earnings report first to confirm whether the cash flow is still okay or not.
Yeah.
Cool.
So we have a next question from Beres Wolf, and he asked, which quarter two report do you most look forward to?
So before I answer this question, Beres Wolf, if you're listening, please start your blog. You're such a smart guy. I love your tweets and your threads. Just start it. Yeah, I know you say you're busy. It's about creating a habit. Just do it. The world will be a better place if you start contributing with your knowledge. Now, to answer his question, I'm really looking forward to Starbucks. Starbucks is one of those companies that I would love to have in my portfolio. I find it just a really, really great brand. I think there's so much potential for growth. I mean, just go to Starbucks and you will see during the day that the shop is half empty. I mean, if they figure out how to fill that shop, and they will start figuring that out as soon as the growth starts to decline on the coffee. And if they really start to just get, for instance, vegan food or something like that, something that resonates well with their customer, I think that's their growth path, and that will be their next catalyst. And for me, it's a McDonald's, what McDonald's is today, 30 years from now. So I would love to see how much they are impacted by the pandemic. I hope quite hard, not necessarily maybe finance wise, but hard enough for the stock price to go back to below 60, because then I will be a buyer. So for me, Starbucks, I will join their earnings call. One of my favorite things to do, joining earnings calls, and I will read the report with lots of pleasure.
Starbucks have always been, to me, I'm quite unsure of them. I'm not sure why. They're quite popular on Twitter, and anyone I speak to are very bullish and very popular stock. But I'm just not quite sure how I feel about them. I suppose I'm in the coffee business myself, and maybe because they're a competitor, I don't like them. But no, I'm just not sure how they grow from here. As you said, if they go down the vegan route, or if they add food, and there is a growth path there for them, but it's just one of those stocks for me that I just can't take to. I don't know what it is, but hopefully for you they drop and coffee sales pick back up and they skyrocket again.
I will be a buyer under 60, so definitely, yeah. Cool. Then we have also a third question from our friend The Money Pursuit, and I mean, also one of those great guys on Twitter. So if you're listening, man, keep on sharing your knowledge. We love you.
Yeah,
so his question is dividend withholding tax on US stocks lower than European-based stocks for European investors? If yes, does that factor into your decision making?
So for me in Ireland, it might be different where you're living, but in Ireland, it is the same as most other countries. So we pay 15% withholding tax on that. If I was to invest in most other European countries, it is also at 15%. If I was to invest in Canada or Australia, I pay 15% as well. So for me, it makes no difference. I know I'm going to be taxed on it, and I can write that off my future tax, so to speak. So I know it's there. It'll be there if I invest in Germany, France, Spain. It doesn't matter, or the US. So for me, it doesn't make a whole lot of difference. But I'm not quite sure what the rules are, say, where you're living.
Yeah. So to answer this question first, the nice thing about buying and purchasing US stocks is that the 15% is deducted, and I don't need to do anything anymore. If I buy a German stock, I pay 26 dot something, and then you have deduction. But what it really is about, I would need to fill in a form in Germany to ask the money back that I paid too much according to the double avoidance of double tax treaty, which is quite a lot of a hassle. So I told myself to start doing that in the upcoming year. I'm going for all the foreign companies that I own stock in, so France, Switzerland, Germany. I'm going to fill in all those forms just to experience what it is, and I will share it also on my blog. But to his point, it's much more easier to purchase US stocks, because also the brokers that we have, they have already this W8EN form arranged for us. This is often not the case with European countries. So does it factor into my decision making? The fun fact is, again, no, because I don't try to use tax as a decision making point. I rather look at the dividend yield after tax for me. So yes, it is much more easier, let's say, but I don't factor it in that much in my decision making.
Good. And great question again. Thanks a million, John. And Slánta Macara, he'll understand what that means.
Definitely. Hey, thanks for the questions. So anyone listening, if you have any questions for us also for the upcoming podcast, feel free to send us a direct message on Twitter or just tweet to us and let us know. High chance that we will address it in the upcoming podcast. But this brings us to the next section, and EMF. It's, I think, one of our favorite sections, but also one of the more difficult ones. What's your favorite stock pick for the upcoming week?
Yeah, I had a tough time this week trying to pick out a stock. I was really looking for a European stock this week, so I focused my attention there. And after 3 or 4 failed attempts, I finally found one that I liked, and it was, I don't know if I'm going to pronounce this right, but it's Walters Kahlua NV. They're a Dutch company, if I'm right.
Correct.
A Dutch company. So you're probably very, very much well aware of who they are and what they do. But at the moment, they have quite a low dividend yield. I think it's 1.73, but they have shown some growth over the last. I think I've gone back as far as 2012 here. So the dividend growth on average in that period was about 6 or 7%, which is fine. That's been heavy on the last couple of years. So it was 16% in 2019. And it was as low as 1.45% back in 2012. But overall, the average is quite good. Their earnings per share is currently 2.46. They're reducing their debt. Their net debt to EBITDA is 1.6. But overall, they looked like a solid company. They seem to be growing. I expect them to grow 3 or 4% again over the next couple of years. Their dividend looks safe. For me, it's quite an interesting story actually when I was going through, because I didn't know anything about them before this week, and how they started as a publishing company, and now essentially they are providing information services and to tax accountants, lawyers, and it's quite an interesting story. And most of the revenue now is online, which I think it was 90% close to 80 to 90% of the revenue is delivered from online, and they're moving to the cloud. So it seems like they've solid growth coming. They're moving in the right direction, and it's definitely a stock I'll be considering buying in the next while.
So I know it indeed a little bit, and I know it is a publishing company. That's also one of the reasons why it was a boring dividend growing company for many decades. Their main catalyst, I think, is data science at the moment. The need for big data. They've got 30 or 40 years of data, or even more data just at their disposal, and then suddenly this becomes a new hype with data science. So I'm not surprised that it pops up on your radar, because I think there's a really, really strong catalyst behind it, and I'm quite confident that 10, 20 years from now, it will be one of the most best performing stocks, probably from the regular dividend growers in anyone's portfolio. I'm quite certain about that.
I hope so. So have you had a think about who you're going to pick this week?
Yes, and it was really difficult because the stock market was a little bit weird this week. But if there's one company that I might consider purchasing this week again, then it's 3M. Followers from my blog know that I regularly recommend 3M, and that's just because every time it dips under $150, it's for me an interesting price to accumulate. Now, what do I like about it? Well, actually, it's industrial. It spends so much on R&D. It's one of the biggest companies investing in R&D every year. Their portfolio today will probably not look the same 3-4 years from now. That's how much they innovate. And at the same time, it's actually quite nicely valued. Their price to earnings ratio is around 18. They have like $8.50 of EPS. Currently spots a 3.8 dividend yield. They've been growing quite a bit, more than their earnings growth and their revenue growth. So I don't think it's sustainable to keep growing like that unless they start growing their earnings again. But for me, 3.8% starting yield is pretty good for a stock like 3M. And actually, also when you look at their free cash flow payout, it's around 60%. So for me, it's anytime it dips under 150, it's for me something to consider. And Maybe it's also good to mention this here, EMF, that I really love the website from IO Charts. And I just wanted to give him a shout out because in preparation for this podcast, I quickly looked up the data from IO Charts. I didn't need to go to Morningstar or anything. I could straight away see it all on one page. So, buddy, IO Charts, keep on doing what you're doing. It's really, really helpful. And I would recommend to anyone, if you want to get some insight in a stock, just go to iocharts.io, have a look at it. I'm sure you will find most of the information that you're looking for. And I loved that for 3M, in one view, it tells me 61 years dividend growth. Where do you see that? I don't know any website. So
61 years. It is a great website, and it's my starting point lately for when I'm starting research. It's probably the first place I go. I use it on my blog and take screenshots and I love these charts. Like I'm looking at 3M here now, and you have the dividend growth chart. It looks good, and straight away I can see 10-year dividend growth of 11% and an average since 2012 of 8.36, and I can see that straight away, which is impressive from 3M, by the way. But to have this on one website is pretty cool and makes my life easier, and probably makes your life easier too.
definitely. Hey, this ends for us a section around stock picks. So let's round up. I'm really curious how the week ahead looks like for you. What are your expectations and such? So if you...
Yeah, this week I'm going to keep focusing on writing some company reviews. So I started on my blog just reviewing companies in my portfolio and putting up my thoughts and why I should buy them or why I shouldn't. So I'm going to keep going with that. Write a couple of articles on my blog. Outside my blog, I'm excited to get back to the gym. It's finally opening back up again. So get out and get some exercise and then prepare for my vacation in 2 weeks' time. So that's my exciting week. How about you?
Cool. So I'm also with my mind starting already at vacation. So I'm going to slowly prepare next week for vacation, probably just by thinking about what I want to do during my vacation, which books I want to read. I'm still having the book from Bob Iger, the biography from the Disney CEO to finish. I really loved the beginning of it, so I will finish that one. And actually, if any one of the listeners has a other good book recommendation, let me know, because I usually read 1 or 2 books per month, and sometimes I need some creativity, and that's the case today as well. But besides that, we're in the end of June. So what it means for me is a quarter review. I don't do necessarily on a monthly basis anymore, because I noticed that I don't see that I add really value with just another monthly post. So I will need to review how I proceeded on my goals, and I can give already a sneak preview that when it comes to my health and sporting, it will it will not be so green. But also, I will then start looking at my watch list for the month of July. I will start preparing for the earnings seasons. I will check out which are the earnings dates, which earnings calls I would like to attend, because it's usually around 11, 12 p.m. in the night. So I need to plan wisely. And I also got a nice comment from someone that one of the stocks in the Noble Index cut their dividends. So I need to do some more research, follow up, and probably then include a new stock in there. So I don't know how much I will achieve in the next week. Usually I over commit or over promise. But hey, it starts with having a goal, right? So
Exactly. You need to start somewhere.
Super. So EMF, I don't know how it's for you, but I really love these podcasts. Thank you for that. And we came to an end to today's podcast already. I also wanted to thank the 20 people that actually subscribe to our podcast on YouTube. For me, I mean, it makes me really humble. Just the fact that 20 people took the effort to hit the subscribe button and to effectively notify us like, hey, we would like to listen more to you. It's just amazing for me. It just makes me peaceful and humble and really thankful.
Yeah, I couldn't agree more. And getting all the messages of support and people writing to me asking, when's the next episode? Looking forward to the next episode. It's like you, it's quite humbling. And I'm just happy to be able to voice a forum for us, a different perspective. And I hope that we are providing some value to our listeners.
Definitely.
Also, next week we have an interesting guest coming on. So someone from one of our listeners from Twitter. So I'm quite looking forward to that. So stick around next week, and we have something fun for you.